So let's begin. Again, we are going to be interviewing Michael Toma today. He's the author of The Risk of Trading, Mastering the Most Important Element in Financial Speculation. And let me flip to the next slide here and kind of give you a brief bio on him. Michael's been very active in helping prop firm and hedge fund traders in risk management. He is a CRM, a Certified Risk Manager. That designation was given to him back in 2007. And he works with corporate risk specialists, and he also trades, and a very active trader on his own. So with that, I'm going to introduce Michael. Michael, if you want to say a quick hello and just a few things about yourself, and then we'll get going.
Yeah, thank you, Brian. It's a pleasure to be here, and a pleasure for the opportunity to talk to your members. It was interesting when you mentioned about you were hoping in the initial poll about the number of people who had no bad what is trading and beginner. I believe there was a total of about 25% of the viewers here today who were either beginner or basically said what is trading. To me, from a risk perspective, that's great, because to me that equals no bad habits. You know, they haven't had the opportunity to earn bad habits. So one of the things we'll talk about as we get into the topic of risk and trading is the elimination of bad habits. So for those who answered the poll with one of those two responses, congratulations. You've already had overcome a hurdle that most intermediate or even advanced traders seem to struggle with. So I love working with traders who have sort of a clean slate and don't have to dust the cobwebs off, so to speak. But yeah, thank you for that nice introduction. I appreciate that. Just to give you a little background where I come from, I started back in 1998 in that SOS Bandit era, and I did fairly well. I can't even remember how I got led into this business, but I did fairly well. But if you remember, for those who had some experience back then, the commissions were ridiculously high. I mean, I think it was around $20, $25 for a round turn trade. And I actually broke even my first year in the business. So I felt, you know, that was pretty successful given those ridiculous hurdles as far as commission. So I took a step back and really continued my work primarily in financial services and primarily in the insurance, health and healthcare industry, basically doing claims management and such things around. And then around 2002, I took a step back because my quote insurance career was really moving at a nice brisk pace. And if you remember back in 2002, the Enron scandal came about, and all these Sarbanes-Oxley regulations came to play to sort of really bring risk management to the forefront. And at that time, you know, when you talked about risk management at a water cooler, people would sort of walk away. You know, now you talk about it, and then they usually follow it with 5 or 6 questions. So as I continued along that journey more towards a risk management path, trading was always in the back of my mind, and I've always traded casually during that time. But I said, you know, some of these risk principles apply not just for the corporate sector, but they really apply. I can apply them to my trading. So I basically made that transition to apply some of the risk principles, and we'll talk about some of them in a few minutes. But I found that my results immediately improved. And so I basically made that conversion eventually from the insurance sector to basically trader, full-time trader, using these risk principles. And I actually even used the same templates I did in the insurance business to help me in tracking my data and things like that. Eventually went full-time. I had a phenomenal coach to guide me through that. It would have been impossible without him. And then 2007, 2008, I actually, believe it or not, it's very difficult and challenging, and maybe some of your experienced traders can understand this. It's tough looking at screens for 8-9 hours a day. So I actually, once you reach a success level that I felt comfortable with, one of the things I didn't expect, that I was somewhat bored in a sense. It could be a very lonely business, very isolated business, and very little opportunity to sort of make the world a better place in a sense. So I got involved in other things, writing, I did speaking, and then eventually I do speaking on the Traders Expo circuits, and obviously teaching and mentoring. And obviously the hedge fund world is always filled with some interesting characters. So, and that pretty much led me up to that point where I'm, pretty much working, doing most of my involvement at a prop and hedge fund, and also helping their traders in the risk management space.
Okay, great. Thanks for that introduction. Mike, let's start out with what I would call a risk management 101 question, and it's this: what is the definition of risk management as you define it? And I know in your book you talked about if you ask that question to 10 different traders, you'll get 10 different answers. So I think it's important we kind of set that definition, especially for the beginning traders that we have with us today. So give us that definition.
Sure. And to really keep it simple, because you can spend volumes on risk definition in theory, whether it's Wikipedia or look in your dictionary, I like to define it in a simple sense. And in fact, all my trading philosophy is really in a keep it simple, stupid mentality. Defining risk management, or let's first define what risk is. Risk is simply the chance of loss, the chance of losing something. Obviously, in trading, a logical loss would be money, principal, capital. But there's also other types of loss: loss of time, loss of opportunity. Maybe there's a trading opportunity that yet you didn't take advantage of. And there could also be loss of a physical asset, such as your computer systems or your data and things like that. Risk management really is the culmination of a number of steps that really make up the entire platform and how you're going to look at loss. All right. And I'm sure we'll get an opportunity to talk about those. The other definition I really want maybe the traders to walk away with, in addition to saying risk is just a chance of loss, also look at risk as an outcome that is different than what was expected. Okay. And often when I talk about risk management, and a lot of people look at stop losses or preventing loss, risk and risk management is really looking at optimizing risk in relation to the potential reward that you can receive. So in the sense of a trade, for example, if you have, and I'll use a futures example, say a 5-point target or 8-point target on the ES futures, and you start taking your profits at 1.5 points, although your account may look green and your trade journal looks all rosy, there is risk in the sense that you're not taking advantage of the optimum opportunity that the market has provided. And as we all know, those profits that you leave on the table often are needed to pay for the obvious losses that will also come. So when you look at risk, not just the chance of loss, but in trading, think of it as the risk of something happening that you did not expect. Risk management, as I said, is the art of looking at all this potential loss and identifying areas where risk may occur, assessing that potential loss, finding ways to control it, and then also managing the risk and measuring it using data-driven type methodologies, and at the same time monitoring your whole risk program. So you may have tweaks in your trading plan, or if you find information in your trade journal that says, you know what, on average, I should be holding this 5 points and I'm taking profits at 3 points. You can monitor and manage those decisions based on the risk principles that you put in your plan.
Okay, great. One of the things that new traders focus on more than the risk side is the profit side. That's the sexy part of the trade. And really, and you state this in your book, risk managers focus on the risk side of the equation. And successful traders really have come to realize that's where the focus needs to be. And you have what you call risk tenants. And I'd like you just to go through a few of those for our listeners and kind of talk about each one of those.
Sure. Well, you mentioned sometimes profits can be, sexy. Well, sexy can be also painful sometimes in a lot of forms of life. But yeah, it's, sometimes focusing on risk is, it's perceived as boring or, sort of methodical. But really, that's the ticket to the show or at least a ticket to the successful show in long-term success in trading. I hear it all the time, even in the hedge fund world. I'm up X points, or I'm up so many dollars, which I cringe, because the last thing we ever want to do is measure our performance in dollars and cents. But you really see the pros that come out and really don't talk about things like that. They're really focusing on plan execution and just sticking to their plan, and obviously optimizing their risk. Again, not necessarily minimizing losses, optimizing the risk. But some of the risk tenants, and this applies to all forms of risk in trading and in basically in life. The two I'd like to share with you today is real simple. Don't risk a lot for a little. All right. Don't go risking $500 to make $50, even if that $50 will happen 6, 7, 8, 15 times in a row, because all it takes is 2 or 3 stops on the loss side, and you'll have an 85, 90% success rate and be out of business. I see this all the time when I do trade journal audits. I see these every day. There's a winning day, and you see this. If I could visually, if you could picture a graph of success or profits coming up, and then all of a sudden in one day, everything is lost and more. And maybe I could ask, maybe some of the listeners are thinking, yeah, that's me. It happens. It's part of the development process. But again, it's clearly an indication that the trader is focusing on profits.
Okay, next I'd like to talk a little bit about your risk identification checklist. And some of the things in that list are not meeting a projected trade result, missing an entry on a valid trade setup, not executing a stop-loss order to reduce risk, the inability to maintain discipline after losing trades, market volatility greater than maximum risk, frequency of over-trading, a big issue, and then the last one here, technological platform failures. So just pick a few of those and maybe speak to them.
Yeah, I think, risk identification, and we'll talk about the other steps in the risk management process shortly, but the one thing you really want to make sure you understand is that risk identification is the most important part of the risk management process. And the reason is you can't assess what the problem is, you can't control it, you can't manage it, measure it, if you can't identify it. So if you don't know what the problem is, you can't use those other steps to sort of mitigate the challenges in your particular trading plan. So risk identification is so key. And the beauty about risk identification is it's relatively simple. However, when I teach beginning traders and even some of the advanced, I don't see them using risk identification principles. They just seem to be looking for profits, and even if they're successful, there's an opportunity to maybe they may be leaving some profits or opportunities on the table. So the risk identification process will alert them to help them in that regard. A couple simple things that you can do as a trader, real simple. You don't need software or anything. Just have a checklist next to you while you're trading. Write the things down that you feel you're struggling with. Okay, if you missed an entry, or maybe after a couple losses, your perfect setup came up and you passed it by because you're a little nervous. Okay, jot it down. Okay, what this is you're building your database of potential issues that you want to eventually add into a developmental plan that we'll talk about. But really, a simple thing like a checklist, no fancy software. Write these things down. The other methods you could do in risk identification is, if you trade with another trader, whether they're experienced or not, bounce some things off of him or her and say, what are you doing? How does this work? Or, could you double check my trading plan? Here are the trades I took today. What do you think? You'd be surprised. And when I first started doing this, I didn't have a trading partner. I used my spouse. I would bounce some ideas off of. And it's amazing some of the responses that you get. But again, you're just digging for potential issues that you think may be a problem. Going a little more of the formal route, which I highly recommend, especially for the advanced traders who, you mentioned in their survey, who are marginally profitable. Part of the ways of reinvesting in your business is really getting the right people or tools to really bring you to the next level. I personally do a lot of audit reviews of trade journals, and you can really detect a lot of information from risk identification about problems, even for some successful traders. It's what is their trade performance after a series of losses? When did they break compliance rules? When did they, if I see too many winning days in a row, and I mean huge winning days, as a risk manager, I get concerned. My audit flag goes up, saying maybe you're getting those rewards, but maybe you're taking too much risk to do it. So again, and lastly, and this is where NetPicks will come into play. Great service. Use experts, and I know it's a crazy business out there, but I don't know how I would have been that successful without the use of experts. Don't reinvent the wheel. It's there's so much good information out there, and to be honest, and I could speak personally, and when I speak at Trader Expos, and some of the best conversations I've had were in the hallways of these conventions, and I just open up to everybody. It's you just have to be a little pushy and ask certain questions, whether it's online or in these venues. I think, Brian, you'll also agree too. We enjoy talking to traders, and it's kind of the thing that keeps me in this business. It keeps me going. So use experts or ones who have been successful and the tools that other people have used to be successful, and really just piggyback on that. No need to reinvent the wheel.
I wanted to share a story from my own trading this morning, and I was trading crude this morning and had one of those technological platform failures. And so you really need to think through and have a backup and contingency plan. I'm really big on that. My situation this morning is I ended up taking a short trade on crude that moved pretty quickly. And the OCO order part of that trade, which is the exit, the stop, and the target, they were on the matrix for me, but they weren't active, and I could tell that. And the trade moved really quickly to my target and didn't get me out. So in that situation, I was hitting the close button to get out of the trade. That wasn't working. I didn't panic, and I ended up buying to get out of that trade, buying at market. And it wasn't 20 seconds later, I couldn't get rid of those OCO orders. They were on the matrix, they went live, and I heard an order rejected. So I had closed out, so they didn't do anything. But my point there is, you're working with technology. There are multiple points of failure in technology, and you should have in your trade desk environment, you should have backup plans for that. My final task there was to call the broker and make sure that I was flat in that situation. So you need to think through those situations and make sure you have a good plan of attack. So I did want to share that specific situation that I had this morning, which is rare, but you do want to have those contingency plans. A good source, Michael, to identify these issues is to have a trade journal and a trade plan. And I know you are a big proponent of that. And so do you want to talk about those two components a little bit?
Sure. Yeah, I am somewhat of a data-driven nut. It's part of my makeup, but that's also my biggest arsenal that I have in my my trading tools to allow me to be successful. One comment I want to mention, Brian, on your trade this morning. First of all, we've all been there. We've all done that. I was a few years back. I was in a hotel in Las Vegas, and on a weak Wi-Fi, and I was in a trade, and I don't know what happened to my stop, but something happened to my bracket order. The hotel Wi-Fi went down, and all I had was CNBC on the TV, just showing the Dow plummet, and I was long the spider. So, once I finally booted up, and it was a lesson learned. But even with all backup plans in place, sometimes you're just exposed to certain things in this business technologically. We can control some of those things, like you mentioned. Not just try to have a backup, but I have a business continuity plan. I have if something goes down, a power outage, I can be somewhere in 10 minutes. I have a backup location. I also have multiple accounts, so I can hedge off another account if it's the broker's problem. So there's a lot of ways we can mitigate risk. We maybe can't eliminate all of it, but there's certainly proactive ways to do it. And if a hedge fund is required to have these business continuity plans in place, well, as an individual trader, you are, in a sense, your own hedge fund. You are your own business. You should highly consider those to do so. In regards to trade journals and data-driven methodology, there is the funny thing about this is, and you really see the traders who advance at a certain level and the ones who try to cut the corners. And I'm just being blunt. 80% of the traders that I initially meet either don't have a trading plan or really don't track their trades. It's what they're doing is they're missing out on the most critical element of their success, because what that trade journal is going to do is play a big role in risk identification. Okay, it's also going to indicate to you what's working as opposed to what's not working. So if I have 5 or 6 setups in my trading arsenal, okay, and you could look at them as 5 employees, because that's I'm in the business of trading. Those are my employees. Well, if there's 1 or 2 employees that are continuously working for me, I'm either going to train the other 4 or maybe get rid of them. But my trade journal and information is going to tell me that. Now, if you have a trade setup that's working really well, you probably don't need a trade journal to figure that out if it's just consistently working for you. But maybe it works better during certain times of the day. Maybe it works better on certain seasonality events on a Monday at 2 o'clock or a Wednesday at after hours. Some of my best futures trades work the best pre-market. All right, I wouldn't know that unless I track them with certain data-driven analytics. So what, again, risk management does is the process in risk identification. It doesn't just identify areas of problems. It identifies areas of opportunity. And once you see those, and if you look like a heat map or something, they'll pop up right in front of your face. What are you going to do as a trader? You're just going to pound those opportunities every time they come across. And you're not even going to look at those setups, maybe where the success rate is less. So it's a very, very powerful thing. You can get really crazy with data-driven analytics. And as I've progressed as an individual trader and then obviously working for a firm, software comes into play. But honestly, the simple way is just, tracking by an Excel spreadsheet works pretty well.
Okay, great. Michael, next I want to talk about risk avoidance. And I really feel like this is key. And basically, this concept talks about benching yourself and not trading under certain situations. And I think that's one of the hardest things to do as a trader, is to sit on the bench and not do what we love to do, and that's engage the market and trade. But there are certain situations where you really need to kind of bench yourself. I'll list some of these off, and then maybe you can talk to these points. But trading when preoccupied with personal matters. I laughed at this next one. Trading when tired, ill, or intoxicated. Trading products that you have no experience with. Trading during specific news events or expected high volatility. Trading high margin exposure, low liquidity, such as overnight markets. Don't pound yourself trying to trade when the markets aren't active. And then the last one, which is really good, trading on psychological tilt. All good, things to consider possibly when you might not trade. Do you have any further comment on that?
Yeah, sure. One of the biggest challenges to success to traders that are in that area where you mentioned in your survey, where they're maybe profitable but struggling, or slightly profitable or just struggling. If you think about it, and the traders listening can think about this, if you eliminated some of those big losses, how would your results be? Would they change a lot? A lot of times, for most traders, we wouldn't be in this business too long if all we did was have losses. All right, we have gains, and that's what kind of keeps us fueled to go to trade the next day. So a lot of it isn't really about improving success. It's about eliminating or identifying the risk, eliminating those activities that aren't working. Right? There are certain things we just have to accept. Market randomness, the technological snafus every once in a while. It's part of the business that we love and we attend to every day. Right? We can prevent some things from happening. Okay, we can back up our data and things like that. But when it comes to one of the things of key parts of risk control is risk avoidance. And if I could just really instill this concept, and you can take it with you, this one idea, and drill it into, I could drill into all the traders' heads. We are, in a sense, are not traders. Okay, so everybody today is fired from being a trader. We're, in essence, we're project managers. We are paid to implement a project. Nothing more, nothing less. Okay, and part of that project, if we're, say we're working for someone, a lot of times traders are working for themselves, but if you think about you're working for a company, your job description is to implement this plan. And a key part of that plan is to be patient. Okay? We as traders are paid to be patient. We are not paid to push buttons. All right? We're not paid to push buttons when we're not supposed to. We're there supposed to implement a project plan and just be patient and wait for those setups with edge to occur. As far as eliminating risk, absolutely. The ones that you highlighted are great. Trading when tired. Intoxicated. You'd be surprised what I've seen in this business. Obviously a no-no. Personal matters is a big one because that affects all of us, even the professionals. We have other things in our life, and sometimes it's just not the right time to do it. And it's one of the biggest psychological mountains you can need to overcome. News events is something very specifically, though, we can control and we can avoid. Personally, in my plan, I don't care how good the setup is or the historical win rate, edge rate. I just don't do it. 5 minutes or 4, my chips are off the table. Let the gamblers come in, the 50-50 gamblers, and play their hand out. And then I'll step in, when things settle down. Really, any other time to really avoid is any other time when your edge is compromised. Okay, we talk about high volatility, but how about these past few weeks with these really slow, choppy markets? A lot of times, maybe the setups are there, but they're just not the opportune reward. You're putting your money at risk, and really the opportunity for reward is really not there. So, take a step back. It is so difficult to not trade. I understand that, and it's a skill that takes mastering and sometimes coaching. But if you could just remember these things, this one thing is just you're paid to be patient. This business isn't easy. If it was, I saw in the survey 6% are successfully professional. I think, Brian, that's about right. I think in the industry around 6 to 10%. Why is that? If this business isn't easy. Paid to be patient, very, very important. And the last one you mentioned on tilt, which is anytime you're just having one of those days where just nothing is working. That's usually the black swan event where you just, when I talked earlier about the account is growing, and then in one day you just see this big drawdown. That's usually a sign of tilt, which from a risk identification standpoint to me alerts some maybe psychological trading that needs to be done. Very, very important.
Okay, great. I have a little story that I'm going to share here. Mark Soberman is the founder of NetPicks, and I know he's on the call today. But this story goes back a few years, and it's when I was involved with Mark early on. And he was actively trading futures like he does today in the morning, trading multiple markets. But in this particular trading session, I'm not going to give you the medical reason why, but he was on some highly potent prescription drugs. That session did not turn out well for him. And we were IMing back and forth, messaging back and forth, and I saw that he was breaking his trade plan. His trade plan at that point was, for X number of losers, and he was supposed to quit. But because of this medication that he was on, he kept trading and trading and trading. And the end result there was he dug a hole that basically wiped out 2 weeks of profit. And at the end, the next day, when he looked back on that, he was just scratching his head. He said to himself, he was just out of control. And so I always like to share that situation because you want to be at 100% when you are trading. And so if you're under the influence of even a prescription drug, maybe it's not the best situation for you to engage the market. So anyways, I always like to share that story. It's kind of a radical one in that, but you do want to be, again, 100% when you're engaged in the market. So whatever the reason might be, don't be afraid to bench yourself.
And Brian, if I could add one thing to that, it happens to all of us. I mean, we sometimes trade on till, but one of the risk control methods is to use electronic controls, such as in that situation, a max daily dollar loss, the broker shuts you down, or things like that. So although we have the capability of controlling risk, don't think I don't use and instill technological controls. They're fantastic. They take a lot of the emotion away when we don't have the capability to do so. So electronic controls would have solved that problem real quick.
Yep. Good point. Michael, next I want to get into loss reduction and how that works in trading, especially with the beginners again that we have in the audience today. And talking about, tightening the stop once you get in a profit area. One of the mistakes I see a lot of traders make is to let a trade go 90% of the way towards its objective and let that trade then turn around and become a full loser. So talk to us a little bit about different forms of loss reduction and how that works.
Yeah, loss reduction techniques are, there's a lot of simple things. And again, we can use technology in the sense of you indicated an opportunity maybe for trailing stops. A lot of the platforms now have very, very good, sophisticated loss reduction elements and tools that we can use. Obviously, the one we can use to obviously stop loss orders that pretty much goes without saying. But again, like I alluded to in your earlier example with Mark, is the maximum loss per day rules. I mean, is the number one bullet on my trading plan when it comes to risk management. You have to have that. And it's just sometimes the randomness of the markets just doesn't play into your hand, and it's time to call it a day. And whether you go to sim or not, it's irrelevant. Live to trade another day. I think the biggest, when I do risk assessments and initial inquiries for traders looking to trade or they're already got their feet wet, I try to look at that sort of their risk assessment mentality. And really, they're focusing on profits. I want to make so much money. In the beginning, this game is about survival. And the way you survive is to just accept those days when it just doesn't happen. When it comes to loss reduction in the sense of, and it's a great example where you're almost at your target. Sure, I'm a big advocate of moving stops to break even pay for the commissions, have another 5-10 cents or a tick, pay for my costs. And I have to tell you, there are times where I am very conservative by nature. I am a risk manager in a sense, not necessarily a trader per se. And I just focus on the risk all the time. And do I lose opportunity? You bet I do. I lose it all the time. I am so picky on price. Price has to come to me. I want a discount at the department store. I don't want to pay retail. Do those trades go in my favor without me? All the time. Do I get used to it? Yeah, eventually you do. But it's still a little frustrating. It's probably the one little part of this business that frustrates me a little bit. But again, that conservative approach is going to allow you to not have those really, really bad days and just churn away. You're not looking to get the whole meat off the bone. You just want to get a little piece. All right. The market provides some nice little crumbs that you pick off the floor, and it could provide a nice living. But remember, this is a game of hitting singles. I see too many home run hitters who hit the home run once in a while, but boy, they strike out. But yeah, that's a big pet peeve where you're right at your target, and they'll just let it go. Take the money. There's always another trade.
Next, I want to talk about the statistical edge and its impact on risk. One of the common stats that we hear is a winning percent. 55% winning rate, 77% win rate, 25% win rate. Can you be successful at each one of those? And really, what's the important factor that goes with the statistical edge in that case? Can you talk a little bit about that, both sides, the win rate and the risk?
Sure. The answer to that question is yes, yes, and yes. You can have, there are options traders who have 22 to 25% success rate, but their winners clearly make up for all those little losers that they have. You can be a 50-50 trader and do well, again, with having more more gains on the winning trades. Myself, my personal thing is I have no problem with one-to-one risk reward in certain setups. And this is coming from a risk manager who, is supposed to preach you have to have 5-to-1, 7-to-1, 8-to-1 risk reward. Hey, I'm sure a lot of people have heard that. You got to have at least 3-to-1. Well, if I'm consistently having 68, 70, 72% success rate on a certain trade, I don't mind taking 1-to-1 risk reward. Okay, so I'd like the traders to leave with that idea that maybe get out of that notion of must be 5-to-1, must be 4-to-1. But again, let your data determine that. Okay, if there's one thing I can sort of leave you with is we hear a lot of stereotypes about risk management and always use stops, and I'm a big proponent of that. It's a big rule in my game. But you can allow these things to play out in the sense that some setups, and particularly options or those type of strategies, you could have a lower success rate. If you want to go forward 5-to-1, let your trade journal tell you that what I'm currently at 2-to-1 risk reward, but the average win or the point gain in this could have been 3-to-1. So I'm going to adjust my trade journal accordingly.
Okay, great. Next thing I'd like to talk about, and you speak to this in your book, it's the topic of confirmation bias and how that can negatively affect a trader's performance versus just strictly taking the trade setups per the plan. And so you want to speak to that a little bit and how traders maybe can make sure they're not, doing that and get around it.
Yeah, it's one of those things. When I was writing about it, I thought I have to include this. I have to include this in as a risk, because I see it all the time, especially among the younger traders, the newer traders, where they do a lot of back testing, and I love to see that. Whether it's electronic back testing or just that manual going through charts. Basically, confirmation bias, to really define it simply, is we tend as human beings to recognize activity visually that supports our idea. And we tend to ignore or not recognize activity that conflicts with it. So an example, say, of backtesting, if I'm going through a setup with a trader, and okay, let's look at the whole week's trading activity for the spiders or the S&P futures, and they'll show me where they would have got in and where their setup was and where it wasn't, or this one worked, this one worked, this one worked. And they end up looking at a back test that has a track record of 85% success. But as they're doing it, I'm looking and say, you missed this one, you missed this one. I mean, it's just a human a hurdle that we have to overcome, that we, again, tend to recognize activity that supports our idea. How to get around that is obviously using electronic software, and you see a lot of the platforms are really making good strides in electronic backtesting. But however, if you do that, hand over your results to another trader or a coach or a risk person. Have them validate your backtest. Okay, if you missed one or two here and there, your overall results may not be that different based on your sample size. But I see it a lot where they say, "Oh, we got to do this. We got to implement this," and I start doing an assessment on someone who wants to implement maybe it's a setup in their plan or even an algorithm, and they're like, "Oh, wait, hold on here, hold on. This is not valid, or your results are skewed." So again, for some of the traders, particularly the beginning traders who are backtesting, first and foremost, great job. Continue to backtest. The more screen time, the better. It'll also give you confidence before you go live. However, have a second person look at your sim results and say, am I recognizing all these opportunities, and am I not discounting the ones that didn't work out?
Great. Next, I want to talk a little bit, and we touched on it briefly, but developing a trade journal. Let's talk about that. And the thing that I liked in your book that you talked about, to me, that was really kind of key, was the compliance factor. Whether or not you were compliant in your journal, I think it's important for each trader to note that. Did you stick to your plan? And then second to that is, if you weren't compliant, what was the reason? And then a second part to that was the emotional status. I like what you did there, in the book in describing that. I think those two things, if a trader will realize what's going on there, they can really affect their trading positively. Again, but they have to track it. Can you talk to that point, please?
Sure. It's to me, it's the key to success, or at least long-term success as a trader. The the trade journal, I see a lot of them have different elements. We always, I see the common ones where, what trade you got in, did it win, did it lose, and the profit and loss. I've always felt the key is having information in a trade journal that's going to allow you to identify opportunities in the marketplace. So, I would include having the day, obviously, in your trade journal. You could use a spreadsheet if you like. It's real simple. The day, the time, all right? Track each, if you have 3 or 4 different types of setups, right? Identify that, okay? Were you going with the trend? Were you going outside the trend? Because what you want to do is look and say, I want to be able to identify what day or what time a particular setup is working. Does it work better when it's with the trend versus against the trend? There are a lot of those type of data-driven analytics that you can use, and those are just a sample of some. But the thing for me, and this is sort of what irks me a little bit, my little pet peeve is when, and even on the hedge fund and prop floor, when I hear traders talking about profit and loss, I'm a big believer. You can put it in your trade journal somewhere if you'd like, but we really shouldn't be measuring ourselves on profit and loss. I know we need, we don't pay the mortgage with plan compliance. However, the focus of the traders, remember, project managers, your project managers implementing a plan. Your success metric, primary success metric, should be, am I implementing my plan effectively? In other words, plan compliance. Okay, your employer, whether it's yourself or a pretend to be boss, is going to promote you based on that metric. So in your trade journal, did you follow your rules in your trading plan? Yes or no? Okay. And in an Excel spreadsheet, I like to keep things very formula driven. So if you did not follow your plan rules, okay, or maybe there was an emotional reason why I was on tilt that day, or I had 3 losing trades in a row, and I got greedy, and I had to get back to break even. Okay, make a list of those common emotional reasons as you develop your trade journal, and then sort of place whether it's a combo box, representative number to them. So number 1 may be I was on tilt. Number 2, I went against the trend when I should have been with the trend. Number 3, I didn't follow my daily maximum loss rules. And what happens is you can formulate and do data-driven analytics saying, you know what, this month, I was pretty good with my trade compliance, and I only maybe 8 trades during the whole month. I kind of fell outside my rules, but 7 of the 8 occurred after a losing trade. So what do you think that tells you? All right. Remember risk avoidance? Maybe we should be a little careful. Maybe lower size after a losing trade. Anyway, those things are some of the elements of data-driven analytics that is so powerful. And for the beginning traders, it's gold. Develop your trade journal, okay? Because I have to tell you, I'm a pretty good trader. I think I'm pretty good. But you know what? I'm an excellent project manager. And that's my goal, to implement a project with efficiency. And I can tell you, over time, the winners versus the losers, the winners will have a high compliance rate and the losers will have a lower one. No questions asked.
Okay, great. Michael, I have 2 more questions for you, and then we will move into Q&A. So next question is, I want to talk about risk acceptance. And the fact that, when I talk to traders, I tell them they have to trade with neutral emotions. You don't want to get excited on the winners, and you don't want to get just totally depressed on the losers. So can you give our audience some suggestions on how, as traders, they can practice and accept risk acceptance?
Yeah. One of the things we do and talk about in risk control is certain risks that we can accept, others that we can prevent. We talked about risk control, some of the methods we can do, stops and trailers and using data-driven analytics. One of the things in this business that we just sometimes have to accept as traders is that things will just happen. It's the ticket that we purchase for the show that we say, you know, we're entering this. We are in the business of risk. Whether we're traders, we are, in essence, we are project managers and risk managers. All of us are, right? And what we want to do is focus on accepting those risks that have really low frequency and low severity. Things that aren't going to happen that often, and things that when they do happen, really don't blow up accounts, okay? Some of those things, and I was using an example in the corporate sector, if I'm overseeing a corporate office and every once in a while there's a pencil missing from the supply room, am I going to go crazy and developing new policies and procedures and training on all this? No, we may just want to accept it. There could be an issue of theft in that situation, but you know, for the most part, I'm going to focus on the ones that are going to allow me to be successful and just let those things, those small risks, accept them. One of them is randomness. The markets just have this random nature to where that's why even the most successful trades, for me at least, rarely get over 70%, 72%. Okay? Because the market randomness of just different participants always in the marketplace will always put a knife into some of my perfect setups at any given time. Okay, we just, again, accept that randomness. The other thing too is, in acceptance, is understand that risk management is not necessarily about reducing risk, right? We talked about it. It's the process of optimizing risk given an historically tested, anticipated reward. I want the traders, when they leave today, to think of risk management not necessarily as stop losses or the other type of identification methods we talked about. Think about it as enterprise risk management, okay? What are the things in my business that can force me to blow up, okay? Most traders, believe it or not, don't get wiped out of this business from stop losses, okay? It could be disability. It could be just technological errors, all right? It could be going crazy on tilt, in a series of things, not accepting losses. So one of the things I want to focus on is accept those elements that are part of the nature of the business of risk, which we are. We enter a business of risk. We have to accept some things. But again, control those other elements that present to you, the big ones that will wipe you out of this business, the 94% that aren't being successful. They're not because of stop losses. They're because of other elements that we have to look into. And those are particularly identified in the risk identification process.
Okay, one final question, Michael. In the final chapter of your book, you talk about how most traders fail and the fact that it's not just a single losing trade that causes that, but a series or large stretch of trades that were not successful. What advice can you leave us with today to help traders prevent this business closing event and head them in the right direction towards profitable trading?
Yeah, I call them the black swans. They're again, they don't happen very often, but when they do, it's a disaster as far as for a trader's business. One, and we kind of talked about them earlier, is look at all your business risks. All right, again, take this enterprise risk management approach. All right, are my systems in place? Is my backup in place? Okay, do I have maybe a small account where I can hedge if something goes wrong with my system? Okay. The other thing too I see, and this is sort of the realities of trading, is a lot of traders, have other sources to help them with their trading, whether it's a trading room or other types of partnership arrangements. Those are great, and a lot of times those trading rooms will help you, increase your account and give you nice trade setups. I've taught in them. They're a great venue. What if one day your trading room just goes under, or just the trader decides to just move on to another venue? You're stuck. So looking at those things, saying not just learning how to get fish, is really learn and develop on how to teach you how to fish. Continuous development in this business will get you everywhere. One of the sort of black swan risks I see, and this is just being honest, and I was kind of a little hesitant to put this in the book, but I said it's so prominent, is spousal risk. I mean, you could be a good trader that's just really catching on. But I think the realities is, and I've seen it a lot, where I just get the call where I say, Mike, I gotta give it up. What happened? My wife lost their job, or she's not, or he or she is just not accepting this business. It's a tough business where it's difficult to convince others than your support group that this is a tremendous business, and it really is, but it just takes time. And a lot of people just have a difficulty accepting the fact that we don't get a paycheck here every week. The whole idea we're in this business so we can get much bigger of a paycheck down the road. So I always recommend engaging your spouse. When I meet one-on-one with a trader, and I'll have the spouse sit on the table, I'll say, usually I'll say, okay, I need you to leave now. And I'll see the spouse leaving. I go, no. I need the trader to leave. I want to engage the spouse and make sure they're understanding of what this business entails and the amount of support that they need to bring to the table in order to be successful. Is it a risk management issue? You betcha. Doesn't sound like one, but this is, again, a big reason why a lot of traders leave this business. But again, in summary of this whole concept is to look at your risk when you identify your risk holistically. Look at all the things that could potentially hurt you in this business. And I could tell you, if you really do it the proper way, you may have stop losses and trading on tilt on your list, but start thinking of those other issues that can force you to either blow your accounts or force you to just leave this business, and identify them early and then have a plan to identify those and rectify them as soon as possible. They may take assistance of a coach or a trading partner, but in the long run, it'll help you out tremendously.
Okay, well, I want to say at this point, thank you to Michael for being with us today. I appreciate you taking time out of your busy schedule. His book, again, is The Risk of Trading, Mastering the Most Important Element of Financial Speculation. I would encourage you to pick it up. There obviously is more good content in the book than we can talk about in a short hour. In fact, one of the struggles Michael and I had yesterday was trying to figure out which of the great topics we could include in the presentation today. So again, I would encourage you to pick it up. You can find it on Amazon or at your local bookstore. So with that, we're going to open up for questions for the next few minutes. And so if you want to go ahead and type in any question you might have for Michael, we'll get those out to him. In the meantime, while we're waiting for some questions to come in, I want to point out we host these author interviews periodically, and you can check us out for this replay. Will be posted on netpicks.com/author series, and you can go to that page also to check out future authors that we will be interviewing. And if you have any questions and want to contact us, you can do so at info@netpicks.com, or you can call one of the direct numbers. Michael, while we're waiting for questions here, you and I were talking before the presentation today about your involvement in mainland China. I thought maybe it would be interesting to share a little bit about that. And the thing that I kind of walked away after what you were telling us is how fortunate we are here in the United States and outside of China to have the vast sea of opportunities as far as investment vehicles go versus what they have inside of China. Why don't you talk a little bit about some of the things that are going on in there?
Sure. It's a fascinating topic, and I'm engaged in it heavily. I do travel to China a few times a year, and there's a tremendous need and demand for risk management in their markets. But you're absolutely right. We are, bluntly, very spoiled as traders. We have a potpourri of products: Forex, stocks, futures, options. We can go long, we can short, we can hedge. In other countries, and in mainland China, it's pretty much a go long and hope type scenario. They've just introduced a few years ago, 2 years ago, their first futures product, which for the first time, mainland China traders can actually short a market, which is very new to them. And as you can imagine, a tremendous need for understanding, education, and risk management. But yeah, we are truly blessed to have all these type of opportunities in the U.S. And other countries. However, I got to tell you, it's a double-edged sword. One of the biggest risks that I see is traders kind of looking at this as a candy store and trading all these different types of products. And I'm always encouraging people to focus on one or two markets, one or two styles, and just master that. And just, again, like pound your computer on those type of setups and be a master of one thing. So as much as in the world of the Far East, they're sort of limited in their trading vehicles. In a way, I'm sort of envious in the fact that it does force them, from a risk perspective, to focus on, in their case, equities, which is pretty much one of the only things they can do unless you work for a banking institution. So we have a candy store of available products to trade. But again, part of good risk management and developing as a trader, developing as a successful trader in your business as a trader, is really focusing on one or two products and just really mastering that craft.
Great, thanks. I do have a question from Deborah. She's asking, what is your recommendation when it comes to back testing, as far as how far back in time and how much data should a trader have to move forward with a trade plan?
Great question, Deborah. Thank you. It's a question I get posed a lot, and a lot of times I see traders. First of all, congratulations for back testing, because it's really, you're getting that first free look without putting any, at least financial capital, at risk. There are so many tools out there that allow you to assist you electronically. Of course, you're welcome to use those with certain platforms. Even at this level, I also like to validate by kind of just getting my hands dirty on a Saturday morning or a slow lunchtime during the summer trading months. The one thing I do see is the ones that are really into backtesting, they tend to backtest too much, because you really don't want to go back to a time level where it just really doesn't allow itself, that data, to be as valid. Markets change, dynamics change. So I wouldn't go past 1 year of data, but more importantly, Deborah, is try not to use a incredibly large sample size of activity. So if you're looking for a particular event, okay, I see traders looking for all the activity that's happened in the past 2-3 years. Once you start getting into the 250, 500, 1,000 numbers of records where this activity or event took place, you sort of normalize your margin of error, so to speak. Simply put, is there's sample sizing information. You could just Google sample sizing standards, and you can basically tell you, if it's so many records, what should be my sample size be. But I will tell you, at minimum, and this is sort of like the simple 101, if you are going to do a simple back test, the magic number I use is 45, all right, just to see if you're on the right track. So if you're looking for an activity that has a certain expectancy or profitability, and after 45, you notice that 30 of them are not working right, you may just want to cancel it right there. One of the most valuable things that we own as a trader is our time. And again, using your back testing time effectively will certainly help out in the long run. In cases like that, less is more.
Okay, I have another question from Lee. He is a beginning trader, and he says, I am considering using a coach or a trading peer. Which would you recommend and why?
Oh, great question, Lee, and congratulations on entering our fabulous business, and best of luck to you. It's really interesting. My answer to that is you can actually have both being the same person. First of all, the elements of a coach that I would look at, if you're vetting them out, and is I really recommend that they actually continue to trade. The best coaches need to be engaged in these markets. And I do see a lot of the trading community that seem to kind of go way of their business of marketing, and not necessarily maintain their engagement as a trader. These markets are continuously trading, and that coach should be heavily engaged in the markets on a daily basis. I'm a big proponent of using a fellow trader, if you have one, and they don't necessarily have to be a professional trader to assist in your coaching. what you want to use for the trader, focus on having them take a second look at some of your work, whether it's your trading plan, maybe it's your development plan, which we didn't really talk about today, but those are the things that you identify as a problem, and then you're going to work on them. Maybe you can be that other person for that trader. So you're going to bang ideas back and forth as far as structural parts of your business plan, okay? Then, from a coaching perspective, this is where you want to get the most out of your bang for your buck. Your ultimate key performance with a coach is to see results, okay? So you really want to measure and monitor results. From a coaching perspective, do they do trade journal auditing? Some of the best traders are great, but they don't have a knack for doing analytics of data. Can they pick out psychological areas of impact that you had in your trade journal? All right, it's very difficult to do. The other thing I would look as a coach too is, why are they doing this? Okay, some of the best traders can really make a fine living doing trading. For me personally, I do it because it's such a great pay it forward, and it really keeps me engaged in this business. I found the business to be somewhat boring and just sort of lackadaisical after a while, and it's kind of given me a second wind, and it's just great to see new traders get that light bulb moment. It's just one of the great satisfactions that can never be compared to a winning trade. So those are the things you want to do. But again, to answer your question, Lee, if you have the opportunity to contain both in your development, go with it. It's a great thing. A third party, whether it's a professional or just a regular trader, is a great foundational piece of your development.
Okay, great advice, Michael. And one last comment here. This one's from John to the backtesting conversation. He's just saying that backtesting should be done in different market conditions, both volatile and quiet. And I agree with that. So, well, with that, I am going to bring things to a close. Again, I want to thank Michael for being with us today. And his book, again, The Risk of Trading and Mastering the Most Important Element of Financial Speculation. I would encourage you to pick it up at Amazon, and it's a really good read. A lot of good information in the book. So, Michael, thanks again. I do appreciate your time, and thanks everyone for attending today.